Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm your host, Oscar Polito. Bond yields are higher today than they were 20 years ago. With inflation indicators falling around the globe, the time of elevated cash rates may be drawing to a close. So what are investors doing? They're choosing bonds in record numbers, with 2023 global bond ETF inflows of $333 billion. My guest today says investors could be moving even more quickly back into fixed income. Why? The signs of market change may be coming into focus. Global central banks appear at or near the end of a tightening cycle designed to quell the most significant surge in inflation in decades, a cycle that made cash so attractive. Today, I'm pleased to welcome Steve Laipply, Global Co-Head of iShares Fixed Income ETFs for BlackRock. Steve will help us understand what has been driving investors towards, or in some cases back, to the fixed income market, and what investors should be looking for as central banks appear set to loosen their grip on interest rates. Steve, thank you so much for joining us on The Bid.
Thanks for having me, Oscar.
So Steve, we're here to talk about fixed income or bonds. We often use both terms to refer to that asset class. And perhaps we can just start with a really basic question, which is, how do investors tend to use this asset class in a portfolio?
Yeah, Oscar, let's start with what a bond is supposed to do. So a bond is basically a company borrowing from someone. So that can be you and I, it can be an insurance company, it can be a pension fund, or what have you. But generally, the way it looks is the company issues this piece of debt. It has a stated rate that it'll pay, and it has a maturity date. When that maturity date, you're supposed to get your money back. And so bonds, generally trade in the market, so investors can buy them outright from the issuer when they're issued, or they can just go into the market and buy them after they start trading. So in terms of what it's supposed to do in a portfolio, if you think about equities are more intuitive, right? We hope they go up. They pay us a little bit of a dividend along the way. That's great. Bonds, if all goes well, you're going to get this payment that they told you were going to get, and then you're going to get your money back. But you're not going to get anything beyond that. And so a good outcome is you getting that payment and you getting your money back. So there are different ways that people evaluate that risk. So people may have heard of the credit rating system, where AAA is really good and BB is not so good, and there's everything in between. And so investors will look at that and look at what yield the bond is going to pay them, and make a decision on whether they think they're taking the appropriate risk for what they're getting paid. Getting to your question on the portfolio, bonds do two things, and it depends again on what the yield is and what the quality of the bond is. The first thing that bonds do, when you use the term fixed income, Oscar, income, right? So in a portfolio, if you think about equity dividend yields are fairly low. They're around 1-ish to 2-ish%. Bond yields actually, as we know, before the Fed hiking cycle, were probably not too far from that. But now we're in a very interesting world where bond yields are back to where they were about 20 years ago. So you can now get a decent amount of income, and as you know, in the Treasury market, in the 10-year note, you can get around a 4.25. At the very short end, you can get 5.5. And so we're in a different world. In the high yield market, you can get much more than that. So now the income part is back. The second thing bonds can do in a portfolio is provide diversification. That tends to be more applicable to higher quality bonds like treasuries. So, if you go look way, way back across time, treasuries, as an example, tend to move in the opposite direction as stocks. And so, what investors would do with an equity-heavy portfolio is hold some amount of high-quality bonds against those. So if the equities go down, they get some protection from the high-quality bonds. And so it's a combination of this income and diversification that investors are looking for in their portfolios.
Right. So they provide diversification to the stock market. And you mentioned treasuries in particular, which are sort of the risk-off asset class that investors will tend to gravitate towards. And then you also mentioned income. It seems like the income that fixed income generates these days is like a capital I income compared to recent years, and you talked about the fact that the yield on bonds is back to 20-year highs. So how did we get back to these 20-year highs?
Yeah, so if we take a little bit of a journey down memory lane, we let's say before 2008, we had yields that didn't look terribly different than they are now. 2008 happened. All central banks all over the world reacted, including our own central bank, the Fed. They cut rates to zero. We had a full decade plus of rates that were very near zero. I think at some point during COVID in 2020, I feel like the 10-year yield got somewhere, I want to say 0.5% at some point. And, maybe it was like a very one day type of a situation. But, that's where we were. We were scraping bottom for quite a while. And that was on purpose. The Fed was, really trying to keep the economy going post-crisis. And, as you know, there were all these programs, quantitative easing, et cetera, that were going on that kept yields really low. Well, coming out of the pandemic, all of a sudden, inflation for the first time in many, many, many decades, and I think quite a lot of people probably had never experienced inflation, and all of a sudden, everyone's Googling that word and what it means and what it looked like in the past and how bad it could get, and sure enough, it comes roaring back, and of course, the central banks react again, going in the opposite direction. They start hiking rates really, really aggressively, and in the U.S., as we know, they went from 0 to 5.5% in a couple of years. And so that some people would say shocked the system. Other people who were rooting for higher yields would say they normalized or renormalized the bond markets back to where they used to be. But nonetheless, here we are. So we're sitting at 5.5% on the short end. And like I said, depending on the asset class, you can get more than that as you go down in credit.
Right. So your perspective on whether interest rates or yields on bonds are high really depends on how far you go back. Compared to a few years ago, they're really high. But as you said, if you go back 20 years ago, pre the financial crisis of 2008, they're really just kind of back to where they were in that maybe more normalized period. So as the Fed has raised rates and done so to combat inflation, a topic that we've spent a lot of time on with some of our colleagues at the BlackRock Investment Institute. So what has this meant for investors? How are they reacting? Does this mean they're more constructive on putting money into bonds, or do you see them sitting in cash a bit more?
So at the beginning of the cycle, and which really took hold in 2022, I think we were all sort of bracing for significant outflows. If you just looked across, whether that was individual bonds or mutual funds or ETFs or what have you, we were expecting just pretty much, across the board, we were expecting outflows. It turned out to be a little more mixed than that. I think if you just look at industry data, yes, you saw outflows in mutual funds, but astonishingly, you saw quite a lot of inflows into bond ETFs, as an example. And then, of course, you saw a lot of inflows into, very short dated instruments like Treasury bills. And I think, that reflects a couple of things. Yes, there was a little bit of sticker shock. People looked at their statements, for example, maybe in a mutual fund they'd held for a long time and perhaps decided to allocate out of that and into cash. But there was also this dynamic where investors got excited about yields that they literally haven't seen, like we said, in 20 years, give or take, right? And so I think that explains some of this allocation that we've seen the last 2 years, into bond funds, because investors are now looking at that and saying, I'm not going to be able to call the top in yields, but how about this? I haven't seen these yields in a very, very long time, and maybe it's time to start getting back in.
And what does it mean for investors, though, as they're allocating to the bond market and some of the areas that you mentioned, when the backdrop is also one of higher inflation? So how should investors be thinking about, on the one hand, their yield is higher, but inflation is also higher? So how do you sort of grapple those two things together?
Yeah, and that's the trick, isn't it? So you have to look at what you're getting paid after inflation, and so this is the whole discussion. And so when people are looking at short-term yields versus long-term yields, and where inflation currently is and where they think it's going to go, a simple thing to do is just basically take the current inflation rate, subtract that from the yield that you're looking at, and decide if that's going to work for you. A situation you don't want to be in, and we were in the situation for some period of time before COVID, was what's called negative real yields. And real just means that arithmetic we just did, where you take the yield you're looking at and subtract inflation. And if it's a negative number, that's tough, right? But we were kind of that way in many countries across the globe for a long time, and we're not now. We're at positive real yields. And that's, again, something that people haven't seen for a while. And I think that's why they're taking comfort in this idea that even subtracting inflation, you're getting a positive return. And that's exciting. And again, if you go from treasuries to investment grade and then down into something like high yield or emerging markets, that return gets, X inflation gets better and better.
The term negative real yield sort of translates into a stealth way to reduce your purchasing powers, is what it sounds like. But it also sounds like we're now in a better environment where even though inflation is higher, yields are compensating you for that and some. So investors are back to at least growing their purchasing power, even if it is a very small amount. Can you say a little bit more about the allocation to cash instruments? Is this a proper allocation, an under allocation? Are clients over allocated or investors over allocated? How do you think about that?
Well, I think it's interesting. So by design, when you increase interest rates this much, when we go from 0 to 5.5, by design, you're going to invert the yield curve. And I think that is designed to tighten financial conditions. And that's just a fancy way of saying you want people to be defensive. You want, the premium for companies taking risk to go higher, for investors taking risk to go higher, et cetera. So investors responded exactly the way that was intended, which is they moved into those very, very short-dated instruments or just outright cash. And so why did they do that? Well, because it turns out you're getting paid more sitting there than you are in, say, 10-year notes, right? And so that was the point. But now they have to start thinking a little bit about, are things changing, right? So, we can talk about this for hours and hours, Oscar, as you know. Are they done? Aren't they done? When's the first cut going to come? Will it come this year? This can go on for a very long conversation. But what I would say is, one way or another, we're probably coming to the end of this particular Fed cycle. And so investors really need to start thinking about what role is cash playing in their portfolio. And it does play a role. You should always have some cash on hand, of course, because you may need that instant liquidity for an emergency or something unexpected that happens. But having all of your money sitting in cash is probably not ideal. And we know the reasons for that, which is that yield that you're seeing in cash today can very well be gone tomorrow. It can change very, very, very quickly. And so that's why you might want to start looking at moving out a little bit more, even if that's a couple years out, 3 years out, 4 years out, where you're locking in those yields for a longer period of time. And so this is the conversation that's very, very much happening right now everywhere, which is, when do I do this? When do I start moving out of cash? I do think it is appropriate now to start having that conversation and start thinking about it, because markets have a funny way of moving before they send a very strong all clear signal. So they're not going to tell you when it's over and when it's time to move. You're going to have to figure that out. And as it turns out, those longer yields move much more quickly than the Fed. And so they'll move before the Fed even cuts. And that's something everybody needs to be aware of.
Right. So there's a bit of anticipatory behavior that investors have to think about. And you touched on this concept of the yield in a cash instrument might be a certain figure right now. It can change quickly. And I think that means that there's reinvestment risk for an investor. What they were getting in their cash instrument can change. It could go up, it could go down, but it certainly doesn't necessarily have to stay stable for an extended period of time. And you touched on central banks. Will they cut? Will they not? This is like a bit of an Olympic sport, I think, now, watching central banks and what they're going to do with policy. Maybe just go back to why that is important. Why do people spend so much time thinking about the next policy decision from the Fed and other central banks, for that matter?
Yeah, and I think this is it's interesting when we look at how responsive the bond markets have been to these pronouncements, whether they're official statements or whether it's just a particular Fed speaker in the news cycle. Markets have reacted very, very strongly the last couple of years. And again, I think it's because we just were in a period for quite a long stretch there where, things were just a certain way. We were kind of grinding around, the bottom. Yes, we had some mini cycles in there, but we haven't seen this in a long time. And I think everybody was waiting to see what the outcome of this would be. Or are they going to land the plane? Are they going to be able to, bring this thing in for the much talked about soft landing, or are we going to suddenly find ourselves, moving far too quickly into a slowdown, and will they have to react to that? So the sport has been all about, did they do the right thing? Did it work? And I think that's why, Oscar, you're seeing so much attention paid, because people want to know what the score of the game is, but they actually want to see what the final score is going to be. I'm not sure that they're going to get that satisfaction, right? Because again, I don't think the market is very good at just giving you these all clear signals, or, oh, the clock ran out and the final score is X. The economy is dynamic, so you might not actually get that signal you're looking for. But that's why everybody's trying to figure out, did they pull it off or not, and what will the next phase be?
And Steve, you've been working in the fixed income market, the bond market, for years, and presumably you feel like you've seen this movie before, where investors are waiting for clues from central banks, and as you said, trying to predict what the final score is going to be. And I think what you're saying is that investors should be thinking a little bit further ahead and not be overly focused on decision to decision, if I'm not mistaken. And so, Steve, what's the bottom line for investors? I mean, you touched on a few of these things, and you referred earlier to moving out to 3 or 4 years of maturities, meaning moving out of cash and moving a little further out the yield curve. But are there areas of the bond market that you're focused in on, and maybe some key takeaways for investors?
Yeah, I think so. I think this is gonna sound obvious, but I think investors have to have certain views in order to make these decisions. So let's take case one. Case one would be if an investor does believe that, like we talked about before, that they pulled it off, that we're going to get this soft landing, we're not going to go into recession. They'll be able to start cutting rates very gradually. Inflation will behave and start, or continue to grind down to 2%, et cetera. You could do a lot of things then. You can have the confidence to invest in, something like high yield. If you believe that the economy is on firm footing and is going to stay that way, and high yield's offering very attractive yields. What's interesting, Oscar, last year, everybody was scared of high yield because of all the talk about a recession, but it returned something like 13% last year, right? So, even though it was yielding, I want to say 8-9%, it returned something like 13%. So, that was one of those contrarian things where people stayed away from it, but it generated a very good return. So if you do think the economy is going to, sort of glide into the soft landing, then you could take more risk in something like high yield or emerging markets or what have you. If you're more defensive than that, then you want to stick to high quality, right? You want to, be in high quality investment grade. And we talked about treasuries. You want to move a little bit further out the curve to get that diversification, get a little more duration in your portfolio to help balance out that equity risk. If you think, I'm not quite sure, we might or might not enter into a slowdown, and I want to be a little more balanced here. And then, let's go with one more, which is if you are very worried that, maybe all of this right now feels great, but we'll wake up, in 6 months or a year and realize we're in a recession. Well, you probably want to be even more overweight to that very high quality exposure further out the curve. Let's just say longer maturity or longer duration treasuries as an offset or a diversification for the equity part of your portfolio, if you think a recession could be a real risk. And also that has the benefit of locking in yields where they are today, because in that scenario, they probably will fall.
Right. So you painted 3 very different scenarios, but the commonality was there's something to do. There are opportunities in the bond markets. And so we will stay tuned to see what the final score of this game is, although it feels like following markets, the game just always continues.
It's always overtime.
There's always overtime. Steve, we appreciate your insights, and thank you for joining us on The Bid.
Thanks for having me, Oscar.
Thanks for listening to this episode of The Bid. If you enjoyed this episode, check out my conversation with Becky Milcham, Are You Leaving Cash on the Table?, where we explore 3 things investors should consider when it comes to cash in uncertain markets. and subscribe to The Bid wherever you get your podcasts.